or won't he? Well, it's almost certain that Fed Chairman Jerome Powell will go in for another 75 basis point hike. And while a 100 basis point hike is improbable, it's not entirely off the table. Given the red-hot inflation print for August, the central bank is going to do what it takes to tame inflation, but it will all come down to projections that Powell will make. Experts believe it's not what the Fed does, but what it says that will be more keenly watched. And typically, global markets have reacted to Fed's rate revision in the past. Right now, we're witnessing a rally of sort on Wall Street. All two major indices are trading in the positive. So what exactly can we expect from Chairman Jerome Powell, and how will markets react to the FOMC outcome? My colleagues Anisha Jain and Sharad Dubey are breaking it down.
The market is watching out for is the US Fed meeting outcome. Of course, the meeting started yesterday. The outcome will be out later tonight, but the street is waiting with bated breath as to what the commentary will be from Fed Chair Jerome Powell this time around. As far as the rate hike goes, well, the street is expecting that there is going to be a 75 basis point hike, and that's largely factored in. Because if you look at the probability, almost 8 out of 10 participants believe there is going to be a 75 basis point hike. Though 100 basis point is not completely off the table, there are 2 out of 10 people who believe that can happen as well. As far as the other context is concerned of the entire setup of the US economy, well, you need to watch out for the fact that the GDP data has contracted for 2 straight quarters. Even if you look at the CPI data, that came in hotter than expected at 8.3% in the last reading. As far as the jobless claims is concerned, they also continue to be, quite high, telling you there is a bit of even mix and match as far as the recession fears is concerned in the economy, because on one hand, the US GDP is contracting, but on the other hand, the jobs data has been strong. In fact, the street will also want to wait and hear from the Fed Chair Jerome Powell. How does the dot plot projections change? Because this time around, we'll get the fresh projections for 2025, as well as the projections of GDP is expected to be cut down for 2023 and 2024 as well. Overall, the other thing to watch out for is the fact that we've already seen a slew of rate hikes this year. It started with 25 basis point in March, and over the last couple of times we have seen a 75 basis point hike, and most likely it is going to be another 75 basis point hike. But how do the markets react to all of this, and what's exactly the correlation with respect to the Fed rate hike and the markets? Sharad will tell us all of that.
Well, yes, Anisha, it's a very interesting proposition over here, and we have taken the last 5 meetings which has been there. And if you see, Anisha, the next day itself, the reactions in the Nifty markets has been a very positive for the one day. But if you see the next 3 days, that is going in the negative portion. 3 out of 5 times if we see for the next 5 days, which was there in 2022 itself, we see the negative returns has been coming. However, just a disclaimer that long-term trend, there is no clear correlation as well. And if you just look at the indices returns coming in from the last meeting, which was there held in July 27, and till date, the returns you see Nifty jumping almost 7%, but the banking indices, the Nifty bank indices, the Nifty PSU bank indices going up between 13 to 15 odd %. So this kind of looks like a very interesting move. However, a lot of things gets factored in as well, as we are seeing in the markets today itself. But going ahead, there might be a difference in the correlation between them, especially with the decoupling happening of India's macro factors. So that will be something very interesting to watch out for.
Okay, let's see how that really pans out. But for now, the street is factoring in a 75 basis point hike.
All right, Ajay Bagga, Chairman of Elements platform and market expert with us on the show. I'm speaking with David Madden, market analyst at Equiti Capital. Welcome to both of you, and thanks so much for joining us. Mr. Bagga, your take first, 75 basis points or even higher? Will Jerome Powell, will the Fed go as high as a 1 percentage point? Or is the realization setting in that these interest rate hikes may be harming more than helping?
No, I don't think the latter is true. Right from Jackson Hole and about 12 officials' speeches post that, they have been very clear that higher for longer. So rates will go higher than the market anticipates, and they will stay higher for longer. Second, that pain has to be undergone. Third, that until inflation trajectory starts coming down, they would continue the hikes. Today is very important in the way, apart from the rate hike, what is the dot plot? The dot plot will be updated after June. So we will get to see rates for 2022 end. Second, we'll get to see the terminal rate and what the rate trajectory is looking like. We'll also get inflation trajectory, GDP growth estimates, as well as the unemployment estimate. So a lot of data points today, Tamanna, and the markets would be watching that carefully. Is 75 basis points factored in? Looks like that. And we expect that 75 basis points would not lead to much trouble in the markets, but things are very volatile, be it the currency market, be it the bond market, or be it the equity market.
David, I just want to get a sense from you on what markets are factoring in right now. We're seeing the Dow Jones about 0.5% up, S&P 500, NASDAQ all doing fairly okay right now. Is that the expectations that a 75 basis point hike is coming and that's okay? The economy is doing not as badly as expected despite this?
I think that's exactly what we're seeing. If you take a look at the losses that we saw on U.S. markets last night, that was the real kind of the last hurrah of selling pressure before the interest rate decision in a few hours' time. So the upward move we're seeing, the fairly modest gains that we're seeing on Wall Street at the moment, in my opinion, really reflect traders' attitude that they're okay with a 75 basis point hike tonight. It also reflects traders squaring up their positions ahead of the actual all-important decision within a few hours' time. I think it also reflects that it's not going to be or unlikely to be a 100 basis point hike. And I don't think there's going to be rhetoric that matches tonight's interest rate hike, which is going to be extremely hawkish. I think it's going to be kind of more of the same. Mr. Powell stated at Jackson Hole something along the lines of that more pain lies ahead, almost implying that Mr. Powell and his colleagues know full well that by hiking interest rates and driving up the cost of borrowing, that's going to cause more and more damage to the U.S. economy. But the U.S. economy is coming from a fairly strong point. After all, the unemployment rate, although it's ticked up to 3.7%, it's still very low in the grand scheme of things. At the previous reading, it was at 3.5%, its lowest in 2 years. So I think the Federal Reserve spent a lot of time focusing on the unemployment rate, which is they've successfully driven down, and they've boosted the jobs market in the wake of the pandemic. Now it's inflation's term, and with that, I think that the focus is going to be on keeping rates at a high level for a prolonged period until inflation starts to make a genuine drop off, and not just a kind of a small, 0.2% or 0.5% decline. Yeah. We need to see kind of percentage points drop off from the headline CPI number before I think the Federal Reserve will look to kind of drastically alter its language.
That's where the challenge lies, doesn't it, Mr. Bagga? Because central bankers around the world are seeing in real terms the truth of how little beyond a point interest rate hikes can do to tame inflation. They come in with a lag effect, and they aren't necessarily the sharpest tool in the kit. We have a situation where you have pretty scary statements coming again from Mr. Putin today. So where will the Fed stop and how far can it go? Isn't that also a big factor right now?
Yeah, absolutely. Very well put. And it is a blunt instrument of policy. Raising rates for the entire economy is a very blunt instrument. It takes 6 to 9 months to flow into the economy. So there is a lag that occurs between raising rates and it flowing through to the economy. Third, both for the government, which is a very highly indebted government, and corporates, it will raise interest rates, it will raise debt servicing obligations. So the damage is quite huge. Our calculations, Tamanna, using the Phillips curve, which, because of very low rates and stable growth over the last 3-4 decades, we saw a lot of talk of Phillips curve not working, but plugging that in, our estimate is that unemployment needs to go to about 6.5% from 3.7 right now for inflation to come down to 2%. So it will be very painful. It's not easy. 3 things can happen. One, Fed gives up the 2% inflation target and says we'll tolerate it for a longer period. Second, it increases the target to say 3%, 3.5% to reduce the pain. Or third, it says that we will use other instruments like QT, like other things, rather than keeping on raising interest rates. So right now, your yield curve inversion is showing that maybe we get a recession sometime next year or early in 2024. Your futures markets are showing 75 basis points today, a good probability of another 75 in November, and ending 2022 around 4.25, ending 2023 at 4.5, and the first rate cut, the pivot coming not before first quarter of 2024.
Those timelines is matching what you're expecting, David?
I think that's exactly what we're going to see, whereby the Federal Reserve are going to overshoot it in terms of actually what we see with inflation becoming wildly out of control. Then they'll focus heavily on inflation, whereby they will actually hike interest rates to the point where it'll actually possibly damage the economy, and then as mapped out by the kind of swaps market and what the short-term interest rates are pricing in, rate cuts in early 2024. I think that is entirely plausible, and I think central banks will probably never learn the lesson of being excessive being excessive in their tactics when it comes to chasing down one economic statistic. As I mentioned a moment ago, all the focus was on unemployment, which is successfully driven to a 2-year low, but it came at the cost of 40-year high inflation. Now it's almost as if all of the focus has been entirely switched over to the other side of the boat, as it were, and now they're going to keep on hiking interest rates until they get that stat down, and then by the time they get inflation under control, hopefully in the next year or 18 months, chances are the unemployment rate will have risen back up and again, and in turn, in about 15-18 months from now, we'll probably have rate cuts to actually try and support the jobs market.
You know, we talk about this in abstract terms, but think about it. Things have to get more expensive. Interest rates have to go up enough until people lose their jobs in large enough numbers to want the Federal Reserve to reverse its direction. In very real terms, that's what it means. Thank you so much, Ajay Bagga and David Madden, for joining us today and breaking that big story down for us.